Well, the government is misleading us again, and not only are they misleading us with the labor report, but unfortunately, they're potentially misleading the Federal Reserve as well. Now, that's not to suggest that the Federal Reserve is stupid, it's just to suggest that the Federal Reserve bases a lot of their actions on what the labor statistics are telling us. And when the labor statistics come in hot, guess what the Federal Reserve does? They get a little more aggressive. Last report of the labor statistics came a little hot, and what'd we get? We got Jerome Powell, who came out just a couple weeks later and acted a little more hawkish and suggested the labor market was so tight and wages were still increasing that the three parts of inflation that we have to deal with, only two of them were actually coming down. Goods inflation and household inflation, like rent inflation, is finally starting to rotate down, but wages are surprisingly sticky and they're still going up, and that could lead to a wage price spiral, which would crash economies. And I hate to say it, but the Bureau of Labor Statistics once again came out and actually had to revise some of the garbage they gave us last month. And even at that, they're still misleading us with some of the other numbers. In this video, I'm going to break that down for you. First, this one a little bit more benign, but shows you graphically some of the issues. So Jerome Powell, who was a little frustrated last month, was referring to the light blue line, that average hourly earnings based on a 12-month rate of change had actually risen in the last labor report. And that made Jerome Powell nervous. But the Bureau of Labor Statistics screwed up, and they ended up revising the average hourly earnings change from last month to, instead of rising, to actually lower and then flat at a lower level, and then down. In other words, great versus bad. That we could see depicted, or actually written out right here. We had average hourly earnings for the last 12 months that came in at 4.6%. The estimate was 5%, and the last hourly earning read was also revised down. That revision down was critical. We saw a revision down to 4.8% from 5.1 for those year-over-year figures. That's a big shift, and that actually suggests, wait a minute, maybe there's actually more slack in the labor market than we think, which is a good thing to some degree because it removes that last massive fear the Fed has of a wage price spiral. Now, don't get me wrong, I'm all for people making more money, but not to the point where it looks like people are making so much more money that the Federal Reserve has to destroy your job, make you get unemployed, and destroy the economy much more than they actually need to because they think the economy is much stronger than it is based on all the phony money printing they did leading to all this inflation that now they're fighting. But that's not the big part. The frustrating part with the Federal Reserve is they continue to look at some of these headline numbers where we go, oh, look, the headline number here, we were expecting to get 203,000 jobs. What did we get? We got 223,000 jobs. Oh no, the employment market is still very, very tight. Now, the Philadelphia Fed has come out and suggested just about 3 weeks ago, wait a minute, maybe we're overcounting people because there are two surveys. There's an establishment survey, which counts how many payrolls there are. Then there's a household survey, which counts how many people are actually working. And that means maybe we're double counting people who have multiple jobs. And what did we find out happened between November and December's jobs reports? Well, shout out to Zero Hedge. Take a look at this chart. It's damning. Job changes from November to December. Ready for this? Full-time job changes, minus 1,000. Part-time job changes, plus 679,000 jobs. Multiple job holders, plus 370,000 jobs. Look, usually people in this market work part-time, not because there aren't full-time jobs available, they take an extra full-time or a part-time job because they have to. They have to supplement their income. That's why you get a big bump in multi-job holders and part-time. But then you also see another bump, sort of the rest of the chart, right? Because if multi-job holders, let's say this is the multi-job holders portion, you still have another part over here that's part-time that isn't also full-time. And that could be represented by a couple things. A, people with full-time jobs need to get an additional part-time job, not because they want to have an additional part-time job driving Uber or doing DoorDash, but because they have to. They're Americans. They pay the frickin' bills. They do what they gotta do. They get another job and they get through a hard time by working harder and paying the bills rather than giving up. They keep going. Now, that sucks. You don't want to do that forever. It's hard, but hopefully that pain is temporary. But you also see an increase in part-time workers potentially as people who retired realize, oh, even though I got a nice COLA, cost of living adjustment for Social Security, dang, things are still expensive out here. I gotta go get another job or get a job again. So you enter the labor force as a part-time individual. This is a very different story than seeing, oh, number of jobs went up by 223,000 in December. Well, what kind of jobs? Well, apparently not a lot of full-time jobs. Apparently a lot of part-time jobs and multi-job holders and massive changes in those sectors November to December. But if we actually look at March to December, so we zoom out a little bit more, what do we get here? We actually get a decline of full-time employment by 288,000, a net increase of part-time employment of 886,000, and multi-job holders up 684,000. Point is, between March and December, it looks like we have actually on net lost full-time employment. Yet, what does the Bureau of Labor Statistics tell us? Well, they tell us that we've actually created 2.1 million more jobs than the household survey shows. But what kind of jobs are we potentially creating? Well, it doesn't seem to be full-time work. It seems to be a lot, to some degree here, part-time and multi-job work. Now, this is a little wild because you have a Federal Reserve that is starting off with looking at these headline numbers. And they're saying, uh-oh, looks like we have wage inflation. Looks like we have more jobs being created. It's time for us to be more aggressive and talk about how we're going to raise interest rates more. But it seems like there's a very real risk. The Bureau of Labor Statistics isn't actually doing the best they could, and maybe they're trying, but it's hard for them with the data they have. But it doesn't look like we're getting the best in terms of clear data. When we zoom in and we're starting to realize, holy smokes, we're losing full-time work. Average hourly work weeks are also declining. Now that's another issue compared to all of what I've just described. That's another issue because watch this. If you go here to the average hourly work week for all employees in this last report declining by 0.1 hours, that's actually very important. I'll give you a very quick example. Let's say you're paid a salary of $2,000, okay? So you're paid a salary of $2,000. That's different from being paid hourly, right? But let's say you, in your case, are paid salary, $2,000 per week, okay? If your average hourly work week was 34.4, like it was last month, 34.4, 2,000 divided by 34.4, that implies you were paid about $58.14 per hour. But if your average hourly work week actually went down to 34.3, then 2,000 divided by 34.3, it makes it look like you made more money. In this case, about 17 cents more money. 17 cents might not seem like a lot, but it's a big deal because when we look over here and we go, the average payrolls in the last report increased 9 cents, then that implies wage inflation is occurring. But wait a minute. If in this example, 17 cents was made up by the fact that you got paid the same amount, even though you worked a little bit less because there was less work to be done at the factory, then a lot of potentially that wage increase could actually be written off as a shorter work week, which actually might mean wage inflation in reality is flat or negative. That's wild. So piece all of this together here as sort of a bottom line, and you see how wild this is, okay? So what do we have? First, we have that the headline numbers double counting people, and even the Philadelphia Fed said this. The Philadelphia Fed said that in Q2, the BLS suggested we created 1.1 million jobs. The reality was more like maybe we created 10,000 jobs. The Philadelphia Fed pointed out that the Bureau of Labor Statistics might be wrong, okay? And that's because of the double counting. But it's not just that. Where we're seeing the real big increase in jobs is in part-time jobs, multi-job holders, which when you have multi-job holders, it's an implication that there's economic stress, and actually a decline in full-time job holders. At the same time, average hourly earnings may, we're not certain about this, but may appear higher as the work week shrinks. So all of a sudden, I don't want to come across as like, hey, I'm just looking for reasons to be like hopeful here. In fact, I'm not very hopeful when I look at the government data, because it seems like the amount of revisions we get and the amount of sort of misleadingness that we get with headline numbers that aren't actually reflective of what's really happening, it makes you a little frustrated, because the labor report we got, that headline number implies, oh man, dang, that job market, it just continues to be tight. What the heck? But then you break it apart and you're like, wait a minute, we're barely creating jobs according to the Philadelphia Fed. We're getting people who are working more because of, well, rate hikes and inflation, leading to more pain in the economy. People's household net worth is going down, their stocks are going down, their car values are going down, everything's going down in terms of things that you own, which is very painful. So people potentially get another job so they can go buy that new paintball gun or whatever they want. And hey, I'll go paintballing with you, okay, big fan. But anyway, then what else do you get? You get a decline in full-time workers. Now that's weird, because you think, like, does this mean people are less needed? Oh no. Well, if that's the case, then maybe it means production is actually falling and companies realize we're going into a recession. They're actually laying off, which is what we're starting to see. Even McDonald's is talking about laying off more of their corporate staff, and their stock's only down like 1% year over year. And average hourly earnings may actually appear even higher as that work week shrinks. That's wild. And in my opinion, seeing this, I become somewhat hopeful that soon, and remember, hope is not an investing strategy, okay? I'm a licensed financial advisor, I run an ETF, I run educational courses on building your wealth, link down below, long-term investment mindsets, buying real estate wedge deals, I teach you everything I know. And I'm not here to say hope is a good strategy, but I am here to say that the more we look at the actual deep dive numbers, the more concerned I get that the Fed is going way too far, way too fast, and they're acting based on numbers that may actually not be as accurate as they think. And that's scary, because when you have somebody driving the car that doesn't even realize they're being reckless, you're tightening your seatbelt because you're like, dude, we're coming in for a crash, man. Happy Saturday, everyone. Thank you so much for watching. Consider sharing the video if you found it helpful, and we'll see you in the next one. Good luck and goodbye.